Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. Thank you for joining us today. Our topic is PPP, the Big Picture. This webinar will be approximately an hour long, and our speaker today is Lee Kidder. Before we get started, there are just a few reminders. We do encourage questions. Please use the Q&A feature to ask your questions, and we'll leave some time at the end of our remarks to answer as many questions as possible. Additionally, we will be opening the lines for you to be able to ask questions and or answer questions that Lee has prepared. You will do that with the raise your hand feature. We'll remind you when we get to that point in the presentation. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Lee?
Thanks very much, Renee, and welcome everyone. Good morning, good afternoon, or good evening. And thank you for tuning in to this presentation. This is, by my count, the fourth update we have done at AFS on the the Paycheck Protection Program, PPP, and it's quite possibly our final one, given the upbeat economic projections that are in place for the next several months. By nearly all accounts, the PPP program has been a resounding success. It has saved potentially 9 million small businesses and self-employed workers. It has saved an unknown but obviously huge number of jobs, and I say unknown because the government has not kept count of those figures. It has injected over $700 billion of liquidity into the economy, and its deferral features have protected the credit quality of countless loans. Just last week, the program was extended to be able to, for borrowers to be able to apply for loans for the third time out until May 31st, and it has increased available funding also 3 times. Even now, as the deadline was extended for 2 more months, there are calls from lawmakers for yet more funding. Now, as of last weekend, there are about $50 billion remaining from the 2021 account. So financially, for at least 9 million organizations, PPP has been a phenomenal and life-saving success. But it has been a wild and woolly ride for most of its year-long duration. It has been beset by frequent rule changes with ensuing confusion, technology outages and delays, problems delivering to the very small businesses and self-proprietors, operational snafus, criticisms about favoritism by banks and exclusion, anxieties about forgiveness, loopholes allowing large companies to take advantage, and a decent amount of fraud. 2 steps forward, 1 step back, changing the tires on a moving car. What we want to do today is to take a holistic look at the PPP program in its entirety, warts and all, to examine it from several participant perspectives to try to tie it all together. And then at the end, to let all of you tuning in to have an open opportunity to submit your own comments from the perspective of PPP lenders and servicers. So let's get underway. This slide shows the legislative history of the PPP program. You may remember when it started just about a week ago, a year and a week ago, the initial expectation was that there would be a huge amount of economic disruption lasting only a few months. So the program had an expiration date of June 30th of last year. It was initially funded with $349 billion, and that funding ran out literally in 2 weeks. So at the end of April of last year, there was another act, the PPP and Healthcare Enhancement Act, that threw in another $310 billion of funding. I want to point out, by the way, that on this slide, the orange or yellowish ovals represent funding rounds for the program. I'm going to refer in this webinar to just 3 rounds of funding because I'm combining the 2 that affected the 2021 amounts. So toward the end of April, as I said last year, the extra amount of funding was included, but then the demand for loans it tapered off and really flattened out for a few months. There were a number of reasons why that happened, and I'll be getting into a lot of those later, and many of them have political causes. So during the summer last year, the demand really flattened out. And another act changed and amended a number of the features of the program that had run into some trouble or caused some confusion. They reduced the original 75% of cost that had to be dedicated to payroll down to 60%, extended the weeks that could be covered for the spending activities, and applied a number of rules to expand eligibility and change the forgiveness aspects. By August 8th, when the application deadline occurred for those initial rounds of funding, there was still $137 billion remaining that had not yet been used. That effectively lapsed. The Treasury demanded that the Fed return the money, and the Fed did so toward the end of the year. So between August and December of last year, there really was a gap. Toward the end of December then, because the pandemic was still raging far beyond the initial expectations, the program was relaunched, refunded with $284 billion, given an expiration of March 31st. But that expiration was extended just last week by another act, the PPP Extension Act of 2021. So now potential borrowers have until May 31st to put in applications for loans. And the SBA was given another 30 days beyond that to the end of June to approve those loans. The 2021 program had a number of changes to it to try to correct a number of the problems that occurred in the original 2020 numbers, and to be able to provide loans for more borrowers than were able to receive them in the year before. These are the key features of the 2021 program. I'm not going to be able to go into all of the details of them because there are very, very many, and that really isn't the objective that I have today. Probably the key change that was made was the authorization of what were called second draw loans. These would be second loans available to companies that had fully exhausted their first loans, still had economic need, but there were some restrictions on them. The maximum loan that they could draw was $2 million, down from 10. They had to document that their sales revenue had decreased by 25% or more from the pre-pandemic levels. And it was limited to companies with 300 employees or fewer. The program was closed in this 2021 round, at least for the second draws, to public companies. They were prohibited from applying for loans. The processing fees that were given to banks were changed slightly. At the smallest level, $50,000 and less, banks did not get the 5% figure. They got smaller of 50% or $2,500. Beyond that, for the 3% and 1% levels, the numbers are exactly the same as they were last year. The forgiveness process, which has been a problem throughout the entire PPP program, was changed a number of times. There are now 3 forgiveness forms, depending upon the size of the loan. A one-page form was put in place by the SBA for loans under $150,000. Ironically enough, that one-page application form for forgiveness had 5 pages of instructions attached to it. And the forgiveness period was provided on a more open basis so that companies could essentially self-select what period of time they wanted to use for their expenditures. There were also a number of set-asides that were put in place in this program. The 2021 program started off in the first few days in January with a set-aside window for the smallest lenders and minority borrowers, where they could be the only ones accessing it. There were some set-asides for the hardest hit industries, restaurants and hotels. Actually, in the American Rescue Act that was separately a large piece of legislation that provided $25 billion of grants for restaurants and hotels to help out their troubles as well. Now, in looking at these 3 rounds, there are some interesting elements about the funding that was involved. The first round literally was 14 days long. That was the very beginning of the program. $349 billion disappeared in 14 days. And the average loan size was $206,000 for loans during that period. Round 2 was the extra $310 billion that was added to that level. And it brought down, as you can see, the average loan very considerably. That was the time when smaller companies were finally able to get access to the SBA system. They had been pretty much excluded in that first round of 2 weeks by the tremendous volume of loans that were put in. In fact, that first round, the first couple of weeks in April, was described by one participant as a stampede through the eye of a needle. And that's a pretty accurate statement because of a number of the problems that occurred, as I'm going to get to in a few minutes. That first round involved some issues as well that became problematic later on. There were allegations of favoritism for existing customers by banks. News reports got out about large companies being able to get loans. Smaller borrowers were complaining in media stories that they were being squeezed out, etc. So that round 2 atmosphere, I think is important to note out, was when there were a lot of rule changes that were made. I'm going to get into that in a few minutes as well. And this multitude of rule changes, many frequently asked questions, etc., created an atmosphere of uncertainty and anxiety among potential borrowers. In fact, so much so that a lot of borrowers did not apply during that period in the spring and summer of last year. And in fact, a lot of loans, 170,000 loans, in fact, were returned, aggregating about $38 billion in those first couple of months. Businesses were understandably anxious and afraid that even had they received the loans, even with the loans they did receive, they were worried that they weren't going to be forgivable. So a lot of them were returned. And this all has to do with the lack of clarity and the huge rush of loans that were set out during those periods last year. This is how that same information looks on a timeline. As I've just mentioned, round 2, which went from the end of April out to the middle part of August, that was the period where most of the uncertainty and anxiety about frequent rule changes and the lack of clarity played out. Applications for loans fell off, many got returned, and by August, when the application deadline passed, $137 billion of available funding was left over. So as I said, the Treasury insisted that that money be returned, and it was so in the 4th quarter of last year. Therefore, round 3, the current round, which began in the 2nd week in January, was passed in December and started again effectively from zero in its funding. Now, there's an interesting feature of this slide that I want to point out, and that is a very accidental but beneficial correlation between the 2 scales here. The scale on the left refers to the orange line, the number of loans that have been approved, while the scale on the right refers to the dollar volume of loans in the hundreds of billions of dollars. Ironically enough, the 2 scales correlate exactly, such that one loan on the left scale is equivalent to $100,000 on the right scale. So that makes it possible to see how the average dollar volume of loans really flattened out and changed between the initial opening rounds and this year's rounds. As you can see, In the early stages, the orange line, the number of loans, I'm sorry, the dollar volume of loans was greater than the number of loans, indicating that the average loan was well over $100,000. By this year, however, that average dollar amount had decreased considerably, such that the number of loans was greater than the dollar volume of loans. There are some very good reasons for that, and in fact, it strikes at one of the very original purposes of the entire program, which was finally able to be corrected only in this round after the problems that occurred last year. Trying to get this slide to move, and I'm having some trouble. There we go. This slide shows the split between first draw loans and second draw loans for this year's current round. And I should point out here that all of the financial data that I've been showing you and will continue is current up until March 28th of last year. As luck would have it, the SBA published its most recent figures just this morning, too late to be entered into these slides. So this information is about a week old, but I have looked at the key figures that were published this morning, and I can tell you in several respects what they were. The important thing that I want to point out on this slide is the heavy preponderance of second draw loans over the first draw. While the number of loans that were issued for second draw purposes is quite a bit higher than the number of first draw loans, the difference is really much more phenomenal when we look at the dollars involved. 2 million second draw loans as opposed to 1.5 million first draw loans, but the dollar amounts are very much different. $180 billion in second draw loans compared to only 31 billion in new dollars. And you can see the huge difference in the average loan size as well. This difference indicates really remarkably that the industries that were so badly affected in last year's program, particularly restaurants, hotels, construction, and manufacturing, were still being hard hit this year. And that plays out as well by virtue of the information that the SBA has supplied about industries that are getting the loans. Hotels and restaurants have received by a large margin the largest share of the 2021 dollars at nearly 20%, while the nearest industries to those are well below 15%. And it's interesting as well that the average loan size has continued to drop very considerably. I mentioned I just picked up the latest figures this morning that are accurate through April 4th, only last weekend. The average loan size has dropped already, and this is for the total of 2021 loans. The average loan size has dropped already from $59,000 to $55,000 just in the matter of that 1 week. This chart simply reflects the overall aggregate of the entire program. The top line is for both years, 2020 and 2021. These numbers I can also update as of just a few days ago. The number is now over $9 million, 9 million loans that were approved, about 9,100,000. And the total net dollars for both years is about $745 billion. In this year, the loans have increased up to about 3.9 million loans in the 2021 round, and the dollars are about $235 billion. There were over 5,000 banks, actually I shouldn't say banks, but 5,000 lenders involved in both years of the program, including a lot of fintechs, community financial development institutions, minority deposit institutions, They were all opened up for participation in the program over the course of the last several months. This slide, I think, has some pretty interesting information on it. What I tried to do was to look at this information a little bit differently than you usually see it. Most of the tables that I've seen anyway of the leading lenders in the program have ranked them according to the dollar amounts of their loans. What I did instead was to rank them according to the number of loans that have been released. And I did so deliberately to try to emphasize the pretty prominent role that fintech lenders and smaller community banks have been playing in this process. And you can see that here. What I did as well was to show the ranking of the top 15 banks for each of the previous 2 years. But the numbers that you see in the white cells are the total for both of years. There are a few instances, as you can see, where a lender may have shown up in one of the previous 2 rounds, but not the other, and that's indicated by the asterisks. If you look at Itria Ventures, for example, they had the highest volume of loans issued in this year's round, but they were not in the top 15 in 2020. They were close to it. I should point out as well that fintechs, since they were originally improved in spring of last year, have been issuing loans very, very aggressively. A number of lenders like OnDeck, Square, Stripe, PayPal, QuickBooks, they are mostly in the top ranks of lenders, and they're probably not very far below number 15 in either case. It's interesting, though, that there have been media articles from borrowers that have used these fintech lenders indicating that they were able to access loans for these borrowers quickly, conveniently, with a lot of the technology innovations that they put into place. But a number of the fintechs got poor marks for services and support and just plain procedural help for their clients. So apparently the fintechs provided a great deal of benefit by their speed, but their support in other aspects was lacking for a number of lenders. You may have seen in that regard the article on CNBC yesterday about Cabbage and the comments made about it since they were acquired last year by American Express. The forgiveness process has been problematic throughout, and it's proceeding at a fairly slower pace. And there are some reasons for that. Because of the haste with which the program was put into place and implemented, a number of problems occurred with loans by way of exposure of large companies getting loans, some instances of fraud that were discovered, a lot of reticence by banks about the process because of the lack of the usual due diligence that's done for these loans. Banks were expected to rely upon borrower certification alone. So I suspect that there's a lot more deliberate review of loans that are taking place during this forgiveness process. After all, the forgiveness process essentially is the heart of the entire PPP program. So as you can see here, there's a lot more review and time being spent on this process. Banks have 60 days to review a forgiveness application once it's received from the borrower. The SBA has an additional 90 days beyond that to do any review that it wants of loans. And as you can see here, borrowers are taking their time or having some trouble even getting applications submitted. For about half the loans that were originated last year still have not turned in their applications for forgiveness. So I'm expecting that we're going to be seeing quite a lot of appeals and litigation over this forgiveness process so far. Remember that the actual decisions about forgiveness are likely to be made by lenders, and that the SBA is for the most part likely going to rubber stamp those decisions by the banks, unless there's a compelling reason or a unique situation that would warrant a separate SBA review. So law firms around the country are already predicting that there's going to be a lot of litigation, a lot of appeals, especially and primarily in cases where forgiveness is not granted to a borrower. So I want to spend a few minutes now looking at the entire program from a number of different perspectives, starting with the political one. The PPP was essentially a political and financial experiment in policy. The focus was on speed at the beginning. The focus was on the perceived requirement to flood the economy with a lot of fiscal relief. The CARES Act in total was $2.3 trillion. The PPP program itself was actually only a small part of that. But that program was put together really in a hurry. Just a matter of days for that matter. It was signed into law March 27th of last year, and it was open for business 7 days later on the 3rd of April. And I think that this focus on speed, while probably it was the right political and financial decision under the circumstances, it developed a set of problems that dogged the program throughout its entirety. Problems in reaching hard to reach businesses, especially minority owned small businesses, sole proprietors, hard to reach those that were without established bank accounts. And between the 2020 and 21 rounds of the program, the SBA commendably tried to put in place a number of corrections to fix those issues and established rules that were giving priority to those smallest businesses and smaller lenders. But again, haste got in the way and prompted a number of problems in that instance. If I were forced to reduce the PPP program to 3 bullets, I think they would go as like this. Number one is that the pandemic inflicted enormous economic disruptions in addition to the very, very sad health losses that occurred. Number two, the political response to that was to inject an enormous amount of money into the economy to try to save businesses and jobs that were affected. And number three was that haste worked, but it contributed to an array of confusion, delays, anxiety, and operational disruption that offset some of its benefits. And I want to get into a number of those issues for the next several minutes here. Now, as I mentioned at the beginning of this webinar, successive legislation and multiple rules that were put into place quickly were an attempt to fix some gaps, tighten the clarity of the program, eliminate some loopholes. You can see some instances of that in the bullet here about legal but ethically questionable. This was when it became publicly known that large public organizations like Ruth's Chris Steakhouse, Nathan's, famous hot dogs, the Los Angeles Lakers had all gotten loans. And that caused quite a lot of criticism around the country, and especially by borrowers that still were unable to get access to the program. From another political perspective, the SBA became the owner of the PPP program because it was attached, obviously, to the 7A program. But the Treasury Department pretty plainly ran PPP in both policy and funding negotiations with Congress. Secretary Mnuchin was really the leader of the PPP policy apparatus, and the SBA, in effect, became the operational partner of the program. Banks had little leverage on the political aspect of it because PPP, in practicality, gave banks funds at better than market terms. And so they were put to the side for that particular aspect. And as I mentioned, there are likely to be quite a few legal issues going forward. There will be appeals of some of the decisions on forgiveness. There are likely to be some after the fact reversals upon review of loans, and these are likely to be based on the definition of eligibility that was put into place. You may recall that especially after the news broke about public companies getting loans and a lot of large companies getting loans, while the small owner-operator, self-employed people were unable to, that the SBA put in a rule, driven by the Treasury, they put in a rule indicating that they would do a thorough review of all loans over $2 million, really focusing on the question of necessity. Was it economically necessary for you to apply for this loan? Now that issue was not present when the program began, and so it put a lot of businesses that had received loans into a precarious position of having to address that fact themselves. Did they really need the money? So the SBA created a 9-page questionnaire that were distributed, maybe not to all companies that got $2 million and more, but to a great number of them. And the results of that are still being worked upon. The Inspector General's Office of the SBA was given funds to continue investigating PPP issues through the year 2024. So we've probably got 3 more years of examination and investigation ahead. And I think that quite a lot more is likely to be uncovered, especially fraud in some applications. On the regulatory side, as I mentioned, the SBA was put in the role of operations partner, and it deserves a good bit of credit for giving it a valiant effort while it was pretty much on the defensive because of haste and political pressures throughout the program. But that notwithstanding, the SBA operated in and unwittingly caused an environment of confusion. As I mentioned, political requirements forced the program and many changes to be implemented virtually immediately. So a lot of the technology updates were rushed, perhaps not well tested, and they created a lot of problems, either operationally or in terms of understanding and confusion. The SBA came in for some harsh criticism from within itself as well. Its own Inspector General and the Government Accountability Office, which incidentally reports to Congress, came out with some harsh reports about the program on the SBA side. The GAO came out with a report last spring that said that the PPP was caused, undue confusion was caused throughout the program by the urgency that was applied by the SBA. A little later on, they came out with another report indicating they had found nearly 692, there's a typo there, that should be millions of dollars, not $692. Duplicate loans were issued last year to multiple companies that had the same address, the same tax ID numbers, and they put a statement in their report that the SBA did not always have sufficient controls in place. So over the course of the gap between last August and December of this year, the SBA put in a number of corrections and changes, and the expectation that there was going to be another round, and they were. They put in a new origination portal with an improved user interface. These changes were praised by banks, but it turned out, again, that the pressure, the changes and pressures and haste with which they were put into place created a number of procedural and other technological problems. The only thing I think that was consistent in 2020 for the PPP was change. And I put this table together to indicate how rapidly and how voluminous those changes were. If you look at the first 3 months of the program last year, for example, 28 new or amended rules, the IFR, the interim final rules, were put into place over the course of 3 months. Imagine that, 28 rule changes in about 12 weeks. No wonder there was so much confusion. And these rules, the changes that were made by these rules were not trivial or insignificant either. Many of them made the difference between a company being eligible or not for a loan, made the difference between loans being forgivable or not, or a company being compliant or not. Now, one of the most notable and potentially the most consequential rules was the definition of eligibility that I mentioned just a minute ago, where economic necessity was installed as the criterion for being eligible to get a loan. And that's likely to be the basis for quite a lot of litigation going forward. As you can see as well, FAQs, frequently asked questions, 50 of them just in those first 3 months. Fortunately, the volume of changes for rules and so forth dissipated over the course of the summer. And so things seem to be working out a good bit more smoothly in 2021. And even the number of new forms and amendments to forms flattened a bit as well. So the activity has been considerably more quiet this year than it was last year, but it was not without a rash of operational problems. There were some privileged access windows that created backlogs among loans and borrowers that were pushed aside. There was a change in the loan amount calculation that occurred this year that created quite a stir. You may recall that the Biden administration declared that for 2 weeks from the end of February until the middle of March, the access window was going to be open only for very, very small companies and quite a few small lenders. They were also changing the calculation rule that those companies could apply for by declaring that they were no longer restricted to their net profit in determining how large a loan they could apply for, but they were going to be allowed to use their pre-tax, their general revenue instead of net profit. Now that caused a problem for about 400,000 borrowers that had already applied for and received loans based on the old rule of using net profit as opposed to pre-revenue. And there was a lot of flack and mistrust developed because of that. Remember also that was occurring early in March. The program was due to expire for application's sake by the end of March. So that created a huge backlog of loans that were still waiting either to get approved or to get their forgiveness decisions made. And that was one primary and especially important reason that the application date for the program was pushed out beyond the end of March. Operationally, I think it's a fair assessment that the lion's share of operational problems occurred in the first few days of the program. But they did leave a residual impact of glitches, bottlenecks, and procedural delays throughout the entire program. Now, one very beneficial offset to that, however, is the huge impetus that these problems gave to technology innovation and transformation among participants. The comment at the top of this slide about 14 years worth in 10 days is actually an understatement in terms of the number of loans. In fact, the number of loans that were uploaded in the first 2 weeks of the program amounted to 30 years worth of the regular volume of SBA loans. And the SBA ordinarily in a 12-month period approves about 58,000 loans. And they were able to upload 1.6 million loans just in those first 10 days. Now, lenders were understandably very hesitant during this time period, especially because they were expected to move applications quickly based only on borrower certifications without the customary full diligence that those loans would apply. So what appeared in the media during this period were the problem stories and anecdotes, the stories about small lenders that were unable to access the SBA system, companies that were getting conflicting information from banks and the like. There were about 5% of the 5 million loans approved last year had what were called anomalies. These were either eligibility problems, formatting problems that didn't quite apply to the rules, issues about calculations, false positives in eligibility, and so forth. And as I said, the SBA put in more controls in place for this year's round, but perhaps they overcorrected in some cases. A lot of false positives in error codes were problematic in the last couple of months. There were formatting problems because of the changes that the SBA made in its automated vetting process that required banks in a number of cases to correct their own systems to be able to meet those requirements for the new formatting change. Sometimes banks just simply couldn't win. The SBA rolled out a new one-page forgiveness application in mid-January and announced it with a lot of publicity, but it didn't begin accepting these forgiveness applications until the end of the month. And the borrowers that were affected placed their blame on the banks without knowing where the problem really did lie. At the beginning of the program, there were requests by the media to divulge more information about the identity of the companies receiving loans, what the amounts were, and the Treasury declined to do that, saying that this information was confidential. So about 10 media organizations filed a Freedom of Information lawsuit against the program to release that information. And a federal court sided with them in November. So that information was released in December, and it really amounts to the major contribution, I think, that media played in the entire program. Because this lawsuit and the information that was divulged was what disclosed to the 600 plus large loans that went to public companies. It disclosed a number of loans that went to members of Congress or White House officials or their spouses and families. There were about 100,000 loans that were given to churches. Loans were given to anti-vaccine organizations and a number of other instances that I called earlier legal, but perhaps questionable. $500+ billion worth of loans were originated last year. and only 25% of those loans were under $150,000 to the small companies, which amounted to the heart and soul, effectively, of the purpose of the whole PPP program. So that's what prompted the SBA to announce its full review of eligibility and the 9-page necessity questionnaire. Media coverage was often, as you might expect, critical of the program, tending to focus on negative and anecdotal aspects, the anecdotal stories from this or that business around the country that had a really exasperating, troublesome experience in getting through it. But I don't think overall the media was overly biased or partisan. There were critical and favorable stories alike that came from organizations like the New York Times and CNN on the left, as well as the Wall Street Journal and Fox on the right. Now, what I put on the bottom of this slide are some headlines that I think are typical of the way the media presented these sorts of stories. You see the one from MarketWatch about the Paycheck Protection Program gone from lifesaver to mess, fraudsters laundering millions of dollars, et cetera. The stories that were favorable tended to be more bland and less spectacular, and I suppose that's what the news media are in business of doing, is selling copy. Now, AFS was, of course, very actively and proudly involved in the PPP program, not only as a system of record for our clients, but as a strategic partner to guide, support, and collaborate hand in virtual hand with them to work through a number of obstacles and the heavy loan volumes. In fact, referring back to the table I showed you of the top 15 PPP lenders a few slides back, approximately 1 out of 3 of the loans processed by those lenders was processed on an AFS software system. And approximately 40% of their dollar volume went through AFS. We're very, very proud of that fact. Because of the support that we provided in modifying what we called a mass upload tool for one of our clients to enable it to upload 50,000 loans much more rapidly, we were recognized by FinTech Futures with the award for Best COVID-19 Response by a FinTech. And the quote in the final bullet on this page is from one of our clients and summarizes how we feel we work with all of our clients. In another couple of minutes, we're going to give you, the audience, an opportunity to share your own comments about your experiences with PPP. But I wanted to set the stage by showing a few quotes from CEOs and other executives about it. These are representative quotes from Truist, Fifth Third, Bank of Hope, Comerica, and Regions. They're obviously high level and very positive. So we're looking to see if these sentiments reflect what all of you went through in the trenches for the past 12 months. This slide comes from a presentation the AFS Business Intelligence team delivered in February as part of its monthly overview of credit conditions around the industry. The point here is that during 2020, when banks were receiving no interest payments on PPP loans, they did receive loan processing fees ranging from 1% to 5%, which provided a very substantial offset to that reduction in interest. These fees, in most cases, have been held in escrow and are going to be accounted for as, quote, additions to yield and taken into income when banks receive their forgiveness reimbursement from the SBA. And this is going to be over and above the nominal interest rate on the loans themselves. So that concludes the formal remarks I have. And what we want to do now is to open up the mics to any of you in the audience to provide your own commentary or experiences with the PPP program. Here are a number of bullets that I think reflect the impact of the program on banks, starting with the alleged allegations that banks were favoring existing customers for PPP loans at the beginning, the whole experience of disruptions, aggravations, technology problems, and then some benefits like the loan processing fees, deferral authority, the addition of new customer relationships, the reputational impact, and so forth. So my general question to you in the audience is, would you do this again? And what could have made the PPP program less disruptive to you over the past couple of years? So we're going to ask you if you to make any comments or ask questions that you might have by raising your hand on the screen, and we will then open up and allow you to speak. So Renee, I'm going to ask you to manage that process for us, and who'd like to open it up?
Yep, Lee, I'm ready to go. And as soon as someone raises their hand, it just takes me a second to get to them and then unmute them. So. We don't have any raised hands as of yet, Lee. I don't know if there's, oh, wait, sorry. I do have one, Joel Hill. So I'm going to unmute him. Joel, you're unmuted.
Oh, good. Renee, can you hear me?
We can, Joel.
We can.
All right, Lee, I'm going to answer your last question. Would we do it again? Yes, of course we would do it again. You know, and as far as the disruptions and aggravations, if any bank could, I guess, highlight and promote disruptions, it would be Truist and SunTrust. We were doing the PPP program, as you can imagine, and you know, on two different rails using the same technologists that we have in trying to bring our two banks together. So it was completely disruptive. What would we like to have done differently? Just like with any loan product that we promote within our bank or any other bank, it takes months and months to build the product, to test the product before you take the product out to market. I think what the SBA did, is as frustrating as it is or has been, was phenomenal. They launched the product within days. And clearly, there were a lot of IFRs that we had to deal with, but the IFRs were largely based on the feedback that we as an industry were providing for them. So they were being very responsive. They, like us, were probably very frustrated, and they were learning just like we were in how to make this program work. So would we do it again? Yeah, we would do it again. Was it disruptive and frustrating? Absolutely. But again, given the timeline, our technology team, as I know other banks, did a phenomenal job in an agile working environment to be able to, as you said and we say, build that truck as it's flying down the road at 70 miles an hour. So I don't think there's a bank on this call that isn't very proud of what they've done and gives some consideration to what the SBA had did in that same time frame.
Great, thanks, Joel, for that very insightful comment. Any others?
Not yet, Lee.
Are there any questions?
Let me check. No, we don't have any questions either. Hold on. We have Shane Williams who would like to speak. So Shane, I'm unmuting you now. Shane, I unmuted you. You'll just need to now unmute yourself.
Okay,
There you
can
go.
you hear me?
We can, Shane.
Okay, perfect. Yeah, just quick question on what Lee mentioned earlier about the, customer, some customers that became maybe disenfranchised, and that there was a comment about small businesses leaving banks as a result of their experience on the PPP loans. I was just wondering if you had any thoughts on if there were some changes related to customer journey for those banks incorporating that whole PPP process, if they kind of re-looked at that customer journey with PPP in mind and how to get those or win those customers back. And do you have any stats on how many customers left banks as a result of the whole PPP experience?
Shane, I don't. I'm sorry, but your question reminded me that just a week or so ago, Barlow Research did a webinar on a survey of a lot of several thousand small businesses around the country. And the question about changing banks, it came up, as it often does in their presentations. It wasn't specifically related to PPP, but I expect that some of the answers were a result of their experiences with PPP. But the percentage of small businesses answering that survey that indicated they were either planning to or seriously considering changing banks was a few percentage points higher in this year's survey than it has in the past. And I suspect that a PPP experience might be the reason for that. In relative question in that same survey, the reason that banks, that small businesses would consider changing banks, which traditionally had been for better technology, was overplaced this year for the first time by the general level of service that small businesses, and in fact many businesses that are even larger than that, prefer to deal with medium-sized banks as opposed to the larger ones, because they suspect they get a better level of service, friendlier, more approachable relationships. And I'm certain that was reflected in their experience with PPP as well. So if next year's data, or if we start to see survey results coming out soon that indicate a number of bank changes on the part of small businesses, I think we can easily draw the conclusion that their PPP experience was a reason for it.
Right. And maybe as a follow-up question related to your digital, the question around digital transformation and innovation, was there anything that AFS did differently or changed or would like to change with regards to how the system operates today that could impact how you would want to have that processing done in light of what happened with PPP? Is there anything being proposed, or are you what the way things are today is worked beautifully, and you don't see any proposed changes that would encourage more transformation if you had those changes in place?
We have a roadmap for changes that we want to make to our system going out for some period of time in the future. We implement those changes periodically on versions of the system as we enhance it. We worked very, very closely with all of our clients throughout the PPP program, and I'm sure that some of them gave us suggestions about parts of the system that they might like to see affected. That feedback has gone into our roadmap. I can't tell you offhand what specific elements that are in the roadmap were the direct effect of any PPP input from our clients. But I think overall we're quite proud of our system and its capability to work with the clients during the PPP program. As I indicated, we did win that FinTech Futures Award for our response to the problem of having to upload thousands of loans in a very, very quick basis. So overall, we're quite happy that our systems responded as well as they did, and that we were able to work with our customers very closely to surmount any issues that enabled them to use the system to its fullest capability.
And Lee, this is Derek Wise from AFS as well. If I could add on just a bit with some specifics for the response, I would highly recommend taking a look at that article for how we really achieved some impressive throughput for our clients. Going forward, one of the things that we're seeing from folks, and it's on our roadmap, as Lee indicated, was managing and handling deferrals, servicing the loans you've done deferrals on an ongoing basis. So we're looking at that very carefully and looking at some improvements we could make in that area. Our system is extremely well architected for absorbing the volume. We don't have a problem. We use the tools to absorb that volume as outlined in that article. We also have, increased configuration options to be able to support that as well. But taking a look at the deferrals specifically and how to continue servicing those, that's what we're primarily focused on from a product improvement perspective. Does that make sense?
Derek, thanks so much for that excellent backup.
Lee, if I could just mention that we are at the top of the hour, and I'm sure we have folks that have other things on their calendar, and I don't see any other questions. So I'm wondering, would it be possible that we should wrap up?
I think so, Renee, thanks. I want to thank everyone for tuning in. I hope that it was a worthwhile time that you spent with us. I want to remind you as well that in the slides that you're going to be receiving, there are some additional marketing slides at the end of that deck that will give some information about upcoming webinars and topics that you can look forward to. So thank you all again. Enjoy the rest of your day, and we'll see you next time.
Thank you all. And as a reminder, you will receive a link for this recording. Have a great day.